Hey everyone, it's Kirk here again at Option Alpha, and just want to do a follow-up live stream here to the video that we did last night, or I guess the screen sharing that we did last night where we were drawing on the screen, which I actually like doing, in fact, and a lot of people had some great comments about that, so we'll do more of those for sure. But I got a lot of questions from people asking me things, about making non-directional trades and kind of building out strategies in different directions. Because what we talked about, if you haven't seen it, it's probably right below this one. If you're watching on Facebook on either your mobile or your phone or desktop or something. But what we talked about is how to build 3 different directional strategies with a 70% chance of success. And so a lot of questions that people had are things like, well, which one should I use? Do I go bearish? Do I go bullish? Do I stay neutral? And so the reality is that generally speaking, and before I get a stream of comments in here from everyone saying that, it's not always going to work exactly, and it may not, right? But generally speaking, you can choose any direction you want. Like, that's the beautiful thing about options trading compared to stock trading, is that you can choose to be a perma bull, right? Like, everything that you do, you're just a happy-go-lucky person. And so that means every trade that you end up making is a bullish trade, right? And as long as you're targeting the 70% chance of success level for each of your trades, you should win at about the 70%, probability all the time. Like, that's where you should end up over long term. Now, if you're a perma bear and you just, are not a happy person, maybe, I don't know, and you don't think that the markets are, think the markets are too high all the time, or you always see the negative side, like, it doesn't matter what the reason is, but if you just want to trade bearish, you can do that. And you can pick one stock and trade bearish for the rest of your life, right? And again, as long as you're trading at the 70% chance of success level or 80 or wherever you're at, you're going to hit exactly what you're aiming for. And that's what everyone fails to understand in this business, is that it doesn't matter if you're bullish or bearish or neutral. It really doesn't matter. As long as you make enough trades, you're doing position sizing right, you're doing the probabilities of success right. So you're, going outside of that expected move and forcing the market to make big moves in either direction, right? Now, my take on this, obviously, because there's a lot of people who are very successful who do this. We recently had a guy, not recently, I guess, but it's a while back now that we had a guy on the podcast, Cameron Skinner in Show 61, where all he does is put credit spreads on the S&P, right? He's a total bullish trader on everything that he does. And we even talked about in that episode that, he was doing all bullish trades. And I said, why don't you do some bearish trades? He's like, well, I don't want to. And he knows, that he can do bearish trades and neutral trades, but he just wants to do bullish trades. He wants to be a one-trick pony. Now, I personally believe that the downside to doing that, obviously, is that when the market goes down, if you have all bullish trades, then you have a big drawdown until the market recovers. So the more often that you can spread that risk out, however you want to do it, you do a little bit here, you do a little bit there, it doesn't really matter, but the more often that you can spread that risk out, I think the smoother equity curve you're going to have. And we see this all the time when we do backtesting, and we're going to be releasing this backtesting software here soon. But when we do the backtesting on, a put credit spread versus a call credit spread, they win at the same rate. They generally make the same amount of money. All of the same things hold true. It's just your distribution of profits ends up mirroring the stock that you're trading when you go one directional, right? So when the stock goes up, you might make some money. When the stock goes down, you might lose some money. You're still going to generally win, about the same rate, make the same amount of money, right? You guys hear me say this a billion times now, but your payoff diagram or your equity curve is going to mirror that stock that you're trading or that index that you're trading. So my personal opinion is, and my view on this is, you have to spread that risk out, right? So you have to just trade other securities, other markets, and you go non-directional generally, right? So it doesn't mean that you can't take a bullish trade or a bearish trade. It just means take something else, right? In case you're wrong, which we're going to be wrong 50% of the time. So on our directional assumption. So why, should we just always do bearish trades or always do bullish trades? Like, let's do things neutral. If you're going to take a bullish trade, great. Just take another bearish trade someplace else, right? If you like one company, pretend that you hate another company for another month, okay? So I want to follow this up, of course, just to really clear this up, because I think this is a sticking point for a lot of people, and hopefully that helps out. So as always, if you guys enjoy these, give me the thumbs up, the hearts, whatever you guys want to do. Share it online. Help us spread the word about what we're trying to do here at Option Alpha. And of course, I would love to know what you guys want me to cover next. We'll be doing these throughout the weekend here, and then heading out to Vegas later on this week. So we might get a chance to meet up with a couple people out there, which I think is going to be cool. So add the comments in here. Let me know what you guys think. I see a lot of hearts and likes coming in, so I appreciate it for those of you who are joining on here. And we'll talk to you guys soon. Have a great night.